This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
It is now time for our weekly segment of Ask Todd, so please get any of your estate planning questions ready, whether it be about protecting assets from the nursing home, estate taxes, or anything in the estate planning realm. Give us a call at 888-205-2263 and ask your question for Todd Lutsky. Again, that studio number here, 888-205-2263. Todd, how are we doing this morning?
I am doing great, and you?
I am doing just dandy. I want to kick off our Ask Todd segment. I'll be the first person to ask you a question. Massachusetts is set to have the House vote today and the Senate on Thursday on a proposed tax relief legislation that would increase the Massachusetts state estate tax from $1 million to $2 million. Massachusetts is one of 12 states that has a state estate tax, and I just was wondering from an estate planning perspective what this would mean to us residents out there if this change were to go through. To be clear, it has not been passed, but is to be voted on.
Yes, it's phenomenal. In fact, I know we've been watching it closely. In fact, we've reported it right here on the show several times this year. So Maura Healey proposed this initially as a $3 million exemption. Mm-hmm. And it kind of got kicked down and chopped down a little bit during the legislative process, and now it's at $2 million.
Yep.
Let me assure you folks that since 2006, the Massachusetts estate tax exemption is still and has been at $1 million. What that means in English is you can shelter the first $1 million, and there was a cliff rule that if you went over it, you would lose the exemption and you'd be taxed on the full $1 million, $30,000, whatever it is. And so that's how it is and has been. However, with the estate planning that we do for folks, you could shelter with trusts $2 million if you're married. Each spouse would be entitled to a $1 million exemption to shelter in their trusts. Well, where we're at now is we're on the brink, it sounds like, of them passing this legislation that would increase the exemption to $2 million. They also say they're going to try to eliminate, I haven't read the entire bill, but it keeps changing, that they're going to eliminate the cliff rule, mm-hmm. so that it's not going to be all or nothing. You get the $2 million off the top. So if you die with $2 million, that gets subtracted from your estate. It's not a cliff rule.
Sure.
Well, that's helpful. Not only is it helpful, folks, it's going to make estate planning so much better for people in the state. Now, with a basic estate plan, we can shelter $4 million. Wow. So now this means a lot of people don't have to move to Florida or New Hampshire.
Right.
Well, it happens. I tell you in my practice, I see it all the time. I can't tell them it's not a good idea because for a lot of them, it's saving them hundreds of thousands, if not millions of dollars. So in real taxes. So now these trusts, what does this mean for us? It's actually great news. It doesn't mean don't do estate planning. It's all the more reason to do your estate plan, because now more and more people can do not only estate planning to eliminate estate taxes, but if they want to protect assets from the nursing home, we know how to do both at the same time. And again, as you get the estate tax world under control and not as much of a problem, you can focus your attention on the protection from the cost of long-term care. Tremendous. I think this is great for the Commonwealth, great for the people.
Yeah, certainly it is long overdue, as I mentioned. They're one of 12 that have an estate tax, but it's only us and Oregon that have this $1 million estate tax threshold. So an increase seems like it's long overdue, and we'll keep you apprised if that vote is to go through. Taking a quick look at markets here, we've got the S&P 500 up a little bit here, about 5 points, and the Dow Jones off slightly. We're here with Todd Lutsky taking any of your questions in the estate planning realm. Please reach out to have Todd give you his input at 888 888-205-2263. Again, the studio line to ask Todd anything in the estate planning realm is 888-205-2263. We're going to take a quick break here on the Financial Exchange, but when we come back, your questions with Todd right after this.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. You're listening to Ask Todd with Todd Lutsky on the Financial Exchange Radio Network.
We are back here with Todd Lutsky. We're going to go straight out to the phones. Tom in Charlestown, you are on with Todd Lutsky.
Good morning. Thank you for taking my call.
Mm-hmm.
My question concerns on the Massachusetts estate tax.
Yes.
I recently inherited a house that I would like to give to my two sons.
Mm-hmm.
And my question is, that's a gift. And is there a gift tax component to the Massachusetts estate tax, like the feds, where I have to keep tally of this?
Yeah,
gift,
so great question. Gifting always seems so easy. It's like, oh, it's so easy. I just give it away. I don't really need a lawyer. It's cheap. It's inexpensive. It's so complicated, though, folks. Don't. And so here's my advice. I don't know anything about your estate, Tom. This is just one asset in your estate. I'm sure you have other assets that you need to consider. But good news on this is you inherited it. So I'm assuming you got to step up in basis. So if your parents paid, $100,000 and it's worth $1 million today, it's as if you paid $1 million if you in fact inherited it and they didn't give it to you during life, which is huge. So that if you sold it today, you would have zero capital gains tax to pay because your basis would be equal to the fair market value on the date you received it. So that's very good. So if we're going to gift assets away at all, we always want to give away high basis assets. So this is okay. This is a high basis asset. Sounds like if we give it away, we will be giving your children that basis. Okay, we haven't even addressed your question yet. This is a whole capital gains tax thing that we need to consider when we do this. So you will give them that basis. It will be a high basis, and that's helpful. It'll come out of your estate. However, I don't know what your child's situation is, but now it's exposed to your child's future divorces. It's exposed to your child's creditors. It's going to be included in your child's estate for estate tax purposes. Maybe there's a better way to give it to them, if giving is even needed. So maybe there's a better way to give it to him by giving it to an irrevocable trust for his benefit. Now we can control it, protect it from his creditors, etc., and still allow him and his kids to enjoy it. So that's something to consider. The other thing is, do I need to give it away? We got new estate tax legislation in Massachusetts. Maybe we do estate planning and the value of your combined estate, if you're married, is going to be under $4 million even with this asset. Well, dying owning it might be better than giving it away because I'm not gaining anything on the estate tax front. I have no estate tax if I do my planning anyway. The federal estate tax is $12.9 million, falling to about $6.5 million in 2026, January 1. So, again, if I'm not gaining anything by saving estate taxes and making the gift, maybe I don't need to make the gift. So really got to consider whether you want to give it away and what type of assets you give away and how you give it away. Now, finally, to your question, do I have a gift tax? No, Massachusetts does not have a gift tax. Federally, you have a gift tax, but you have an exemption today of $12.9 million. So if I gave away $1 million home, my exemption for federal estate tax would fall by $1 million, and my gift tax exemption would fall by $1 million, and I would be at $11.9 million. Probably no problem. Don't know your situation. What about Mass? True, they have no gift tax. However, they follow the Fed for estate tax purposes. And so because we reduced the federal estate tax exemption by the taxable gift, you must also reduce the Massachusetts exemption by the taxable gift. So if I was giving away that same $1 million and I have a $1 million exemption today, we're waiting for legislation to pass, but today my exemption in Mass would go to zero. And I would have zero estate tax exemption left. So whatever assets you kept, Tom, would now be subject to estate tax in Mass, and you'd have no exemption. So please think about it, folks. You think gifting is easy. It's not, and it may not even be the right way to go. I think you ought to sit with an estate planning attorney for sure. Folks, so much goes on in the estate planning world, and one of the guide that we're giving away this month, in fact, is the top 7 estate planning trusts and demystifying them. In this case, Tom, maybe get the guide, learn how these trusts work, and see which trust might be right for you or any of you that are listening. It explains not only how they operate, but the tax benefits and family benefits to them. Figure out which trust is right for you. Get the guide, 866-848-5699, or go to legalexchangeshow.com. You can download it there. Again, 866-848-5699 or legalexchangeshow.com.
We're going to jump to our second caller. Mark in Wareham, you are on with Todd Lutsky.
Good morning, Todd.
Good morning.
I have a question. I have a Cushing Dolan irrevocable trust.
Mm-hmm.
It's funded with my primary residence plus 2 real estate rental LLCs.
Excellent.
Now, I understand the income's supposed to flow to me.
Mm-hmm.
Can I keep the income in the LLC accounts to fund any expenses that come up, like a roof or a furnace? And if I do so, does that impact the 5-year look back?
Great question. The quick answer is no, but let me explain it. I mean, no, meaning it doesn't impact the 5-year look back, and yes, you can leave the money in the trust or in the LLC for expenses. So how it operates is you're going to continue to collect the money into the LLC bank account, pay your bills, and if you want the net rent, the excess rent, anybody who has this, you're allowed to then distribute that rent. And again, you're the manager, Mark, so you can do this. You distribute the rent into the trust. The trusts are the shareholders, and the trusts say all the income goes to your pocket, into your personal bank account, Tom or Mark. So absolutely, that's how that would work. Do you have to make the distribution? No. You can leave the money sitting in the account. No need to make the distribution. That will not affect the taxation. Whether it's distributed or not, you will still file the 1065, flow the income through, all the income, all the expenses, through to the trusts. The trusts will file their 1041, and they will kick out the income onto your personal return and all the expenses onto your personal return. So your income tax liability is the same, whether you make the distribution or not. And it does not affect the look-back period, simply because the way our trusts are drafted, and I can't say it enough, folks, drafting is the most important thing when it comes to these documents. Our trusts say that income at the end of 12 months, so let's say I earned rental income of $15,000. At the end of 12 months, if I haven't distributed that income out, our trust doesn't say add it to principal. No, right? I don't want to add it to principal, because if I add it to principal, then you're right. It would start a new 5-year waiting period, because it would be as if it came out and went back in. So we don't have it reset the 5-year waiting period. What it is in our trust is simply an account receivable. And so then you can simply take that income out. It just builds up. You could have $30,000 of income after 2 years. Grab the 30 if you need a new car. It's income. So hope that helps, Mark.
The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated.